Hello, everyone, and welcome to Montash's webinar on moving beyond efficiencies, value creating AI use cases. Today, we're exploring how private equity firms and backed firms can get the most out of their AI implementation. I think now more than ever, it's a really great time to be talking about this, as a lot of firms are looking to explore AI with maybe a focus on efficiencies and productivity. When I think actually that's just the tip of the iceberg, and there's a lot more you can get out of your AI implementation. So I'm joined today by three private equity leaders and experts with first-hand experience of AI implementation and strategy, who are going to discuss with us that very topic today. So I'll hand over to my guests for a bit of an introduction on themselves and why they also think it's a really interesting topic of conversation as well. So Manu, over to you first.
Thank you. So I'm Manu. I'm CEO of Awaken Technologies. Previously, I was Chief Data Officer for Bupa and for Richmond Group. And I've set up technology, data, and AI teams for about 20 companies across the globe. What what I think makes this conversation really topical is that we're already seeing that there are AI haves and there are AI have-nots. And the private equity firms are going to face the same pressures. So we're in this situation where the right implementation of your AI strategy can mean the difference between winners and losers. So this is a very important time for this conversation to be had. And I want to bring also, having been a data scientist previously, I want to bring a flavor of what is the state of art of the technology so that you can go after low-hanging fruit with technology that's ready to go live with you. Thanks.
Perfect. Thank you, Manu. And over to you, Stephen.
Hi. For the last couple of decades, my work has been about pragmatically transforming organizations through data and AI to help them deliver their key aims like strategic growth, entering new markets, improving enterprise value, and higher exit multiples. I've been a board advisor and senior leader, as well as transformation lead for new ventures, mid-sized companies, large organizations like Penguin Group, Inmarsat, BBC and ITV, and government ministries like MOD and Department of Health. I've also worked extensively in the PE ecosystem, advising portfolio companies backed by firms like Sovereign Capital and CPP Private Equity. On top of that, I have a PhD, which was focused on the impact of disruption on sectors like law. What I find really important about this today is helping senior teams, boards, and investors practically get the most out of their investment in AI. And I do this through a very pragmatic approach that's based on my experience, my academic background, and also a creative and agile approach to delivering value.
Perfect. Thank you, Stephen. And over to you, Paul.
Hi, everyone. I'm Paul Whiteside. I work across technology, value creation, and private equity for the last 10 years. I've led high-tech growth in private equity-backed businesses, and I currently advise investors about technology, architecture, data, and AI. And what we look at these days is, not just can a company do what it says it does through the diligence process, but can it efficiently scale, can it provide a competitive advantage. What I've seen over the years is that there's a move in AI to go from its early adoption, which was about cost out and productivity, which are very important, but it now focuses more on how can AI be used to drive commercial performance, and private equity companies are interested in how that works across the entire portfolio to give valuation uplift.
Perfect.
As an operator, I've seen a move from experimental AI to a focus on a desire to look at high value use cases. So we're comfortable with things like churn, pricing, workflow. One of the big changes that I'm seeing is a desire to build out longer term capabilities. So it can be quite easy to adopt, but embedding the right capabilities and underlying things into your company, it really helps to build that differentiation and defensibility. So my lens for today is to discuss this in terms of how AI is not just an efficiency lever, but is currently helping to create differentiated products and drive higher valuations.
Brilliant. Thank you, Paul. So if we to kickstart the webinar off, just focusing on the PE life cycle and the start of that in the due diligence process. I think it can tend to be a lengthy process as well, with technology speeding that up. For PE firms as well as firms looking to be acquired, how do you think AI is reshaping the traditional due diligence process? Maybe over to you, Stephen, first for your insight.
Okay. Well, I think what it's doing is going beyond the obvious aspect of where AI impacts it. So that's being able to review data rooms very quickly, thanks to the generative AI tools. I think there are two areas that are impacting DD. One is how we go about doing due diligence, and that is giving us commercial and financial turbo boost through being able to assess market signals, looking at competitors and doing analysis of them, and then also being able to do better future forecasting. And this is allowing teams to test and refine their investment thesis early and often before they purchase. The second area where I see AI is really impacting the due diligence process is probably a little less heralded, and that's it is actually changing the due diligence process. Because if the investment thesis includes value creation from AI, you really need to know that the company has the necessary foundations to deliver on that. What that means then is that the due diligence starts to look at things like data quality, technological sophistication, the governance, and also the culture of the business.
Perfect.
And from my, I was just to conclude then, from my experience, what happens is without that, you have the risk of increased hold times, increased investment while you're trying to fix what needs to be fixed, and then also forcing some hard choices about where and how to deliver value.
Thank you, Stephen.
I think I can add to Stephen's ideas. We've been looking at working with companies. We're doing proprietary sourcing engines. They do similar things to as Steve is describing. You're looking at market signals, analyzing data sets, looking at past deal books, and doing lookalikes to find, for example, acquisition targets before they get in the market. These are, and other things have, as you know, the productivity improvements, firms have said 35 to 80% in things where they've been crunching lots of data, and obviously LLMs are very fit for the task. What I do want to say is that I think that the value that this sector has been getting in due diligence comes from the fact that the technology, we've talked about Gen AI already. I think the technology is mature, so it aligns really well to due diligence tasks and processes, especially those that don't need humans in the loop. So I think it's a reflection of that. I think the rubber hits the road when you come to other parts of the life cycle, like value creation. But I think productivity gains have been targeted a lot in the due diligence process. I think we have to look at the other parts of the stack. I do want to call out that there's a lot of hype around generative AI and agents and all of that stuff. We will get into that later in the game. I talked about how they are mature for the task that we are discussing right now, but there are also flip sides to that. We'll come to that as well as we talk about how technology can help, but also to look at the pitfalls that you can have.
Brilliant. Thank you, Manu. And you're absolutely right. I think with a lot of data to be taken into consideration, whether that's in an organization, but also big data of competitor landscape. I think it's really going to quicken the process up. And I know, Paul, you mentioned in your intro, you've worked a lot in the due diligence space. It'd be great to hear your insight as well.
Yeah, great. So I think AI brings a lot to the diligence process, both in terms of the process itself and the key exam questions that investors are going to be asking through the process. I think in diligence, the human judgment and intuition is always going to be a critical aspect, but an assistive AI can certainly help to cover the gaps, especially in a limited access situation where you want to really understand, where to press and go harder and go deeper. I think one of the key things that often comes out of a diligence is the what comes next question. So the post-deal scenario modeling can be something that we can look into. I think Stephen and Manu mentioned various theses maybe being entertained at the time. So trying to figure out, which ones are going to have the greatest chance of success, and contributing into those conversations. So AI helps a lot. I think there are, you can't fully rely on AI for diligence purposes. You need to know where to poke, where to find the right questions. You need to understand the investor concerns, but use the AI in an assistive way to really target the questioning, to make sure that they do have a capability, to make sure it's beyond brochureware and proof of concepts.
Brilliant. Thank you, Paul. And actually, I can see in the Q&A chat, Al has already asked a very interesting question around due diligence. What we'll do is we'll get to, at the end of the webinar today, we'll answer any questions. So please do fly those questions in and we can address those at the end. So moving on then, as Manu, you mentioned, to the value creation stage. Obviously, that's a real kind of meat on the bone section where AI can really get interesting, as well as be a lot of interesting cases can come out from value creation as well. It'd be great just to get some first-hand experiences, maybe some cases that you've all seen, you've implemented yourselves, where AI is used for value creation. Over to, I guess, Paul to start with.
Great. So we see a spectrum of thesis being entertained and looked at. I think one of the key efficiencies still comes from cost reductions, but people are using AIs in many ways to help drive upside. So whether that is looking at customer churn problem and understanding that, whether it is enabling natural language processing approach to liberating the data within your company, driving your team harder. There are things like call handling. I know of companies using it in engineering for predictive maintenance. They've managed to create a differentiation there for things like air conditioning maintenance or plant maintenance, and use data in very interesting ways. And one of the most interesting cases that we see is where companies begin using AI for onboarding new customers. So this reduces the timescales and risks involved in onboarding customers, and ultimately gives you a fatter onboarding pipeline. So that's very helpful. And some of those things contribute quite significantly to revenue uplift as well. So you see maybe up to 15 or 20% uplift through taking the appropriate measures and harnessing AI.
Brilliant, thank you. And over to you, Manu.
So we talked about deal sourcing due diligence already. We've taken some of Paul's examples. I think you were talking about customer analytics. So I think what we've seen is that where you've been able to drive value has been traditionally where the technologies are mature enough to deliver those things. We talk about customer analytics, churn prediction, financial modeling, back office things like inventory management, supply chain, logistics, all of those. These are problems that have mature solutions that chief data officers and people in these kinds of roles have seen in their careers. These are problems because they have mature solutions. When your portfolio companies, you will find low-hanging fruit along this, and the risk of implementation is much lower because, like I said, you should have been using some proven technologies. And I recommend these solution sets to clients. There's a reason for that, because I think that by implementing any of these technologies into their companies, into the portfolio companies, obviously prioritizing the right use cases, you can start building a muscle for how to implement AI. So you can start building playbooks. And the more you play, the better you get at it. And that's why I would recommend that when you're looking at value creation, go where the technologies are already mature, where the low hanging fruits are there. Be Remove your ego, have realistic expectations for what you can do a really realistic audit of your current state, and learn from each of your AI implementations. Create playbooks, not just for your portfolio companies, but also to federate across your other portfolio companies as well. So I really think that for value creation, these are the most risk averse kinds of ways to get low hanging fruit for your company.
Brilliant. Thank you. And over to you, Stephen.
I'm going to share an example where not delivering AI actually created value. So I worked with a PE-backed debt recovery firm at one point, and the investment thesis behind that the PE had was that the AI could increase value through better decision making. So I had been brought in as basically the chief product, chief data officer. And I discovered that the three companies who had been acquired to create this new company were not integrated at all. Data quality across the group was bad, and senior teams had almost no visibility across the entire debt life cycle. So what I did was I convinced the board and investors that by focusing on data quality, they would improve visibility, and by that be able to improve decision making on cases. And so as we were building the foundations for the data quality and the data processes, which lead eventually to exit multiples, we'll talk about that in a bit, I think. What they were doing was that we were actually giving the teams and the leadership a much clearer view of where cases were, what needed to be done to get them resolved. And that started to translate into an uptick in recovery rates, which was obviously a revenue generating exercise. So part of what my recommendation is to be a bit pragmatic. Recognize that companies aren't always ready for AI, but with some creativity and some lateral thinking, the process can get them to be. You can go through the process of trying to become AI companies and deliver value along the way.
Perfect. Thank you. I think that's a really, really interesting point as well, Stephen. I think a lot of boards and companies are looking at the AI bubble and saying, how can we get on board, when a lot of companies might not have their data at the place that it needs to be to integrate large language models or AI. Just wanted to sort of dive in as well, Manu, and some of the points you said and unpack those a little bit on low hanging fruit. I think obviously we could have the buy versus build debate all day, and maybe that's another webinar. But how can you get the board, and when should you get the board to buy into building maybe a longer term AI strategy, AI products, rather than just sort of buying off the shelf and ready built products? So maybe over to you, Manu, to begin with.
Sure. So the first thing I always ask is, what is the exit horizon and what is the strategy for exit? So if the exit horizon is 18 to 24 months away, and obviously, it depends on the company and the sector and all of that stuff. But if we have a runway of 18 to 24 months, I recommend that for areas where it would be your proprietary data sets can be actually activated, then I would recommend that they build that, because we're going to have some really difficult financial headwinds coming up, as most people can see as the signals come. And I think companies will see a lot of disruption, especially if you're in the SaaS space, you're in the technology sector, you're in certain non-regulated industries. I think there's going to be a lot of disruption, and there will be disruption from things like AI agents and such technologies that are still not mature, but they will eventually get there. So what I recommend to companies, that if you do have the time frame and the right data sets, which most of the companies tend to happen, then building a solution can actually enhance your exit valuation more than if you would buy a off-the-shelf piece of kit that obviously your competitors are using as well. So you're not building a proprietary competitive moat. So I would say if you can build, then it's better than just buying off the shelf, given the luxury of time and obviously the caveat that it has to be sector specific and problem specific. I think that there is obviously an AI talent gap, but one of the things you have to do is, to continuing with Steve's kind of idea about being pragmatic, you have to figure out when you build, most people can't do it just by talent that's in-sourced in their organization. To build strategic partnerships with vendors, contractors, ecosystem partners, not just with the SI folks, because long implementation cycles, but to have that so that you can try to solve the problem. And while you're solving the problem, you can try to build your in-source this capability in-house to do one of two things. One is the quick way is to keep the lights on, make sure that the capability is built, transition to a team that can basically keep the lights on. That's a less expensive thing. But obviously, the best case scenario is if you can have an in-house team that can keep implementing and improving these processes. Thus, your competitive mode becomes stronger, the valuation of your company becomes greater, because as we've seen this year, the truly AI enabled companies are looking at 40 to 100% extra valuations versus their non AI counterparts. So I think build versus buy has to be a judgment call, but those are
Mhm.
the factors that we should be looking at least.
Perfect, thank you. And Paul, looking over Crosslake's portfolio, it'd be really good to get some insight from you on this as well.
Yeah, I think AI is one of those things that's quite easy to get started with and adopt an off-the-shelf package or a tool set. But what you get is something that's quite generic, and getting to the stage of capability where you are refining things and carving out your own niche and creating your own differentiation. This can be done initially via partners, but as Manu referenced there, in the longer term, you need to build your talent and you need to build your capability to do that. So in the longer term, when you do that and you've got the capability, it allows you to leverage AI and deliver internally more quickly and deliver according to a roadmap and create that defensible moat, and also increase the valuation of the company through its efficiencies and its better top line. And I think that the thing is when you want to after you've gone through the initial phases of experimenting with IT and you want to become more domain specific and a leader in your industry domain, that involves building product around AI, productizing AI internally, understanding how it creates new product features if you're a SaaS company, or indeed it can go as far as what individual products and features does it replace altogether, and how would I externalize that and take that to a company. And when you've got a capability like that, it also gives you the long-term sustainability. You're not going to be tied into a vendor roadmap. You're going to be able to be targeted rather than generic. You're going to be able to build more advanced things using RAG models, perhaps, and deliver value targeted specifically at your customers. So there's that level of targeting and positioning in your market that it's going to give you when done right. So a lot of firms are taking a phased approach of an initial introduction via tools, then working with partners to build capability. And then the third stage would be to build out that capability alongside a product roadmap for delivery.
Perfect. Thank you, Paul. And over to you, Stephen.
I think there's actually two aspects that we need to look at, and I'll talk from a PE perspective, but also then from a larger company perspective. For PE-owned firms, there's the aspect of how much focus is there going to be on value creation during the hold
Mhm.
and then also how much is on creating enlarging the exit multiple. So there's two separate but interrelated things going on. The other piece that I always look at is going back to the investment thesis. What was the transformation that was proposed during that hold period? Because there can be two different ways in which this can play out, and I've seen this in both sides of it. So one was a long-term build of AI, starting to build training models, building the data science, the product teams, the in-house IP, if you like, that both Paul and Manu talked about. And this was done in a company that was where the exit and the investment thesis was really about transforming the company into a tech or AI company. So, for example, I worked with a financial services publisher who is making a strategic pivot toward being a data provider. So, in that scenario, it made perfect sense that they were going to focus on building out their teams, their platforms, the models, the capabilities for what they were trying to do. Conversely, I was a transformation lead for one of Penguin Group's companies, and they were looking at AI and technology to help with very specific functions, such as marketing or distribution. They were not looking to transform themselves or to become a AI company at that point. So it
Mhm.
made sense for them to focus on buying in the capabilities to use off the shelf things. And in the end, the sales multiple when Penguin Group was sold to Random House was really not dependent on their AI or technology capabilities. It was dependent on the IP, the books, the distribution, et cetera, et cetera. So I think it's very much depends on the situation that the company is in, what they're looking to do long term, how they're positioning themselves, and then where they are as a company at a particular point.
Perfect. Thank you, Stephen. Yeah, some really interesting points there as well. I think a real sort of takeaway from that is start with the low-hanging fruit, start with the quick ROI, and then move on to longer term strategy, preparing for exit, and what they can build and what they can really get out of it. Just before we do move on to exit, I think we've unpacked it a little bit already, but I think it'd be good just to understand maybe some of the common pitfalls with integrating AI across a portfolio into a company and how firms can avoid that. Maybe over to you, Manu, to begin with for this one.
Okay, sure. I think the pitfalls that PE firms will face are the same that any company is going to face when you do these kinds of data transformations or AI transformations. The first thing that you have to deal with, and it's the biggest mistakes that people don't pay attention to, is the fact that you've got to get your data sets, you got to get them organized, you got to clean them up, and you have to make them ready so that you can use it, and you can use the big boy tools that we're talking about, like generative AI and so on and so forth, to apply on them. It is really important to understand that, one, if you underestimate your data challenges and you don't pay enough attention to data, the boring stuff like the governance, the data quality, the data management, then I think you are bound to fail. The second thing is to audit your current state in terms of processes as well. If you have broken processes, there's no point trying to automate that broken process. So there's no point automating chaos. So it's really important to first make sure you get your data game in order. The second thing is you get your processes. Take a deep, hard look at that. One of the other things that I do want to bring this in here, I know generative AI is on top of everyone's mind. More than 59% of PE firms are looking at that as one of the top investment areas for the next 3 years. But and I'm going to put generative AI and agents in the same block as here as emergent technology that I consider to be very half baked or very quarter baked at this point. If you look at the best models out there, you look at their ability to deceive their users, to hallucinate, to make mistakes. Then the last study, which was about a month ago, said that of the 17 leading agents, 95% of the time they were willing to be deceptive. Obviously, this was a special case in which their survival was threatened. But the point is that they are very, the current state of the art, that these technologies are not yet mature enough that you should be deploying them, especially for customer facing use cases. So it's really important. Most, if we look at the data so far about generative AI, 95%. So MIT did a study, it was like maybe a couple of months old, that said that over 300 companies surveyed, 95% of their Gen AI projects have delivered zero ROI. So you have this case where the successful companies, which are 5%, are doing something right, and that the 95% of the companies are not doing. And I think those are the pitfalls that you need to look at. Don't chase a technology that's not yet perfected. That's not really what you want to do with your portfolio company. Come in with realistic use cases, and don't underestimate the messiness of your data, the governance, and the access and the quality issues. If you solve those, then the state of the art of AI is such that once done, you can train very competent models and solve problems like I've already talked about in the past.
Perfect. And so you, Steve?
I think really we can summarize a lot of what we've said already in this. The pitfalls are unrealistic investment thesis about the impact of AI, um, and an over-indexing on short-term value creation, which leads to a disillusionment with AI. So Manu hinted at the 70% plus or 90% plus failure rate. And I think that's important to keep in mind if we're looking at short-term quarterly ROI and we're in a position where it's an immature and developing market, there is that risk. And so I think, having a bit of pragmatism and then a creativity, as I mentioned in my example with the debt recovery firm, about finding where you can actually get a value on the roadmap to AI maturity helps. So in avoiding those, it's the due diligence that we talked about before, a constant focus on value creation and ROI, not delivering AI. Sometimes not delivering AI produces the value creation. And a balanced view of this quarter versus the exit, and being able to make the necessary trade-offs along the way. Do I buy? Do I build? Or do I focus on immediate or ROI in this moment? Or do I look toward upping my exit multiple?
Thank you. And to you, Paul?
Yeah, well, all of the above, and then sort of thinking about other things as well. You see a lot of people getting stuck in a sort of a prototyping doom loop where tech comes first, and as Stephen and Manu both mentioned, there's a loss of focus on why that is being done and what's the strategy and how will that unlock ROI and become sustainable for the future. So that's just a tech first approach. And sometimes this will happen, when teams are trying things out and trying to learn. But in the early days, even with prototypes, you need to have some exit criteria for, prototyping initiatives so that you have control spend on that and you're managing your outcomes. And another thing that comes up again that was mentioned is poor foundations. So this is, inaccurate data and poor governance. We also encounter sometimes a CEO or board-driven initiative to acquire AI capability, and I don't mean like acquire another company. I mean just do a project, get this horrible project over with, and suddenly we're an AI company. That doesn't work. There's a AI and data maturity journey that you'll have to go on and introduce momentum into what you do. And when you become more mature with AI, things will get considerably easier. But getting there too quickly As Stephen also mentioned, not doing things as important as doing things. You can't do everything, so it's selecting the right initiatives. That's another place where people go wrong. What should I be doing this quarter or this year to balance things? And then the last area is tech debt, especially in larger companies where you get disparate AI initiatives around the enterprise. You get data silos, duplication, redundancy, inconsistency, poor governance, and conflicts, and how AI is being used. So this is very cost inefficient. And again, this can be resolved by planning things, planning a flexible but progressive roadmap that guides the investments that you want to make in AI.
Thank you, Paul. Yeah, really interesting points there from all of you. And moving on then to exit. Now, it might not be at this point yet, but in a few years' time, a lot of firms, when making that exit, might be looking to be more AI mature firms. So I'd love to just unpack some of the ways in which AI tools may change expectations of buyers, investors during those exit periods. Maybe over to you first, Stephen.
Okay. Well, I think this is very much mirrors our DD discussion at the beginning. So buyers are going to be more sophisticated. They're going to and be better informed thanks to AI. So I think there's going to be a lot more challenge around purchase multiples, around pricing, and so forth and so on. So I think as companies who are looking to sell, be aware of that. The other thing then is on the seller side is to be aware of these exit multiples and be in a position to tell a really good story about the value that's being left on the table and why that commands a premium. So I think that it goes back to, what have we done in this whole period or when we own this company that's put in place the governance, the culture, the products models, the growth potential that would then allow the buyer to come in and really realize some significant value with a bit of investment, therefore making the exit multiple a lot higher.
Thank you. And to you, Manu?
Yeah, I think I referenced the fact that AI native or AI enabled companies that really do it where it's not just theater. They have seen high valuations in the earlier half of this year. So I think what I would tell buyers is I've already referenced the fact that you want to look at assets that have proprietary AI or proprietary data assets that they've actually activated. The second thing is that they've done AI, and Steve and Paul have also been talking about this, right? Finding the use case is tricky, but landing it is even trickier. So what you want to do is look for actual impact. So, for example, suppose there's an inventory. Suppose uh, we've increased the inventory turnover, or we've created a supply chain efficiency that needs to translate into EBITDA improvement. So look for real impact, not just theater, because there's a lot of it out there. There's a lot of companies that are saying we do AI because now everyone just feels like they have to do it, but it's not really real. It's just like dressing, it's lipstick on a pig and all of that stuff. And then another thing I want to say is that when you're buying, also be really clear about what is the disruption that can happen just because of the state of the art of tech. You have to imagine that some of the capabilities in non-regulatory remote environments, some of the capabilities of the companies are easily going to go away because we'll have general purpose learners or the dreaded AI agents that come in and automate all of those things. So really be very clear about for the exit horizon, what is the disruption that is going to come from AI as well.
Thank you, Manu. And to you, Paul?
Yeah, so fully agree with all of that. Especially the bit about many investors have become very savvy now when it comes to AI, and have become healthily skeptical they can see through a veneer of salesy roadmaps and buzzwords, and they'll expect to understand, first of all, how it works. How did you implement this? Is that scalable? And of course, what comes next? How far do you want to go on your journey? Manu mentioned, those companies that have proprietary models, bigger valuations, because they're targeted specifically for things that help in their industry, and they're not generic. So what a buyer would expect to see is that you can demonstrate that there is AI-driven productivity and cost leverage. Not just slides about future potential, but how you have implemented your roadmap, what's on the roadmap and why it's there, what you've done already, what did you learn, what were the success factors. Investors ultimately want to see or build an AI-enabled company, so not just one with a bolt-on. So what we're talking about here is, a chatbot doesn't cut it anymore like it might have 4 or 5 years ago. This kind of table stakes now, and really those proprietary models and deep focus that differentiate and create a competitive advantage in your space of what they're looking for. And the biggest thing of all is, once you have done that, how do you defend it? Is it the quality of your team? Is it the ability to reliably execute on your roadmap? They want to see all of that. They want to understand exactly how it's done and where you're going.
100%. Thank you. And we've got some really interesting questions coming through. Manu, did you want to expand on that point?
I think I think we have a lot to cover, so let's move forward. I think I agree with Steve and Paul on this.
Perfect. Brilliant. Keep those coming through, and we'll answer those in just a second. Now, just in summary, as you've mentioned, Paul, a lot of firms now are looking for actionable insights in strategy. The standard chatbots won't cut it anymore. But if you had to summarize, all of you, a couple of actions PE firms and firms could take this year to stay ahead in AI adoption and automation, what would they be? Over to you, Manu, first.
Sure. I think 3 things I would recommend. These, I think, are universals, not just for PE firms. But like I mentioned first, fix your data estate and your operations first. Take a hard look, do the audit, understand your current state. The second thing is pilot with the use cases that are ready, they're mature technologies. I referenced a few areas already. Those are low hanging fruit. I know it's not the sexiest thing, it's not the latest AI agent, but machine learning is fantastic for a majority of the use cases that can directly impact your company's exit valuation, your operational efficiency, bid, all of that stuff. And then the third thing I recommend is that for PE firms, once you start, so if you haven't started anything, then please just, you need to start ASAP. But once you start and you build with, if you don't have your in-sourced data professionals, you find partners that can help you in this kind of journey. But what's really important is that when you do your first pilot use case, go where there's low hanging fruit, go where the technology is mature, learn from that, create playbooks, use these playbooks to federate across. It doesn't seem like it from the outside, but an AI project that is going to, systematize your operations, or an AI project to implement a chatbot, a lot of the steps are actually the same. So creating these playbooks, having an organization that has the muscle to do this over and over again is going to be absolutely critical. To think very much like the COE kind of model, where you have an ecosystem of advisors, partners that you can work with, learn from one, and then federate your learnings and your playbooks across the organizations and the portfolio companies.
Perfect. Thank you, Manu. I think having that playbook is so critical and so key, especially with PE firms that are looking across the whole portfolio. And over to you, Stephen.
Manu's stolen one of mine, which is the playbook, but that playbook really comes through the experience. And I think it's important to have the experience in a number of different scenarios, like Manu is saying, implementing and then being able to abstract out the common elements in that. The other two that I would add is, first of all, don't believe the hype. There's a lot of FOMO out there about AI and how it's going to change everything. But staying focused on value creation and how AI is going to deliver against the investment thesis is where the real value comes. Otherwise, it's just implementing for the sake of implementing. And then the last thing that I would add is be realistic and comfortable where you are. If the organization has low data maturity, has a culture that isn't technical or data decision driven, that's fine. There's still value to be had. There's still multiples to be built. There's still ROI to gain. Just be realistic about it, and that way you also don't end up in the disillusionment and despair of failure.
Thank you, Stephen. And to you, Paul?
So harvesting the success models across the portfolio is really a good thing to do, and taking the learnings and pushing those back to other portcos that may be earlier in their journey. I think as well as that, adding the right people into your operating teams so that you have people who can be injected into those portcos from time to time to help speed that maturity and get them up to speed with it more quickly, rather than just via letting them do ad hoc experimentation on their own. One other area is really around governance, and this is a big area that, if it's not watertight, can really derail a diligence. Governance, security, and compliance areas really can trip things up. But it's easy to document. A lot of that is repeatable. Understanding the key considerations for the company can really help to keep out of trouble there. And then the last thing is just build momentum. So as you harvest the successes and you have the right people in place, the winning PE firms are going to build data talent foundations and embed it properly, rather than treat it as a quick thing to bolt on thing. And when you have that momentum and you have that solid capability, creating new products and business models becomes a possibility. You just need to become airborne first before you become maneuverable. Is the way to paraphrase that. So that's the final thing I would say is establish momentum.
Brilliant. Thank you, Paul. Yeah, really, really interesting insights from all of you there in summary. I think it's very interesting, Paul, when you mention about the operating teams and the need for them there. I personally have seen from a talent perspective a real rise in the need for AI operating partner across PE firms. So that's really interesting to hear. So brilliant. What we'll do now is just time conscious. We'll jump in the Q&A session. We've got some really interesting questions here to unpack. I don't think we'll be able to get through them all, but for the interest of time, what I'll do is I'll read the questions. If you want to jump in and answer, if you feel strongly about a certain question, please feel free. If you want to add on to what someone else has said, let's do that as well. So starting from, we've got a great question from Al here on the due diligence space. He's interested to hear more about the use of big data to shift the question from, is this a good buy and what price towards, and what is the optimal option amongst all permutations, based from ingesting large quantities of market available data, so from companies' house, market data, etc. So really a question around the use of big data to shift the question.
Yeah, so I think external data sources of the kind that you mentioned can help in building out a thesis. I think through diligence, there's always going to be the need to understand, as Stephen mentioned several times, the fit between capability and thesis and what that gap looks like, because that's ultimately where the investment is going to be needed and where the opportunities are going to be. Um, but yes, there is a lot of data out there. Um, uh, when you say big data, usually we're talking about things like quantitative data, but LLMs are very good at analyzing qualitative data and natural language as well. So there are several approaches that you could take without getting into the technology part of it too deeply. Um, but that could certainly provide an advantage in understanding comparatively how your target sits compared to other firms and what the opportunities might be for a particular target, or indeed if you want to position your portfolio in a certain way and look for specific kinds of targets. That kind of analysis will certainly help guide the strategy there. So
Yeah, I think what I would add to that is, again, we go back to, you have to go back to what you're trying to do, right? So if if my fund has a particular thesis for it, if I'm trying to manage my risk profile in a particular way, being able to take in a lot of data and then having a model for understanding and analyzing it, both quantitative and qualitative data, then you can potentially unearth opportunities that aren't apparent, or you can identify risks on the horizon that maybe other people didn't, that would lead you not to invest in certain areas. And I'm thinking particularly now in this climate where there is so much disruption and so much uncertainty, having a model and the tools to be able to analyze what's happening is going to be more and more key as you're looking across your fund's investments.
I'll just add to Paul and Steve's comments over here. I think one of the things. So the state of the art is it, we know that LLMs are really great at crunching large amounts of data. They can look at market signals, they look at your deal books, and so on and so forth. I've found that in the pilots we've done, the reliability of the information we get back from these agents is not, it's not 100%. But I also find we also find, so there are companies out there that have given board members seats to properly trained AI agents and the kind. I think that is a good idea, but I think trust but validate going forward. Really check the output of what your AI is telling you. Make sure that you're really keeping humans in the loop, at least for the first 3 to 6 months. If you're trying to build a sourcing engine or one of these kinds of LLMs that can do signals management and give you, say, what's the horizon to exit and things like that, I really would suggest, and I say this not just for this, but all agentic deployments and Gen AI as well, for a period of 1 to 2 quarters, make sure that your existing process with humans is right there along with this, and wait for the maturity to go where the reliability is so good that you can give away more and more of your control. The future is going to be that way. I do think maybe 2 or 3 years from now, that will be the standard. But for right now, I would really say tread quite carefully with these technologies as they're still evolving.
Thank you, everyone. Perfect. And we've got a very interesting question on around AI governance, which we haven't really unpacked today. So as AI moves from efficiency gains to value creation, abilities and existing teams realistically evolve fast enough if data maturity is already in place?
Hugo, I think we lost. I
I
lost
think
you
we cut
for.
up there a little bit.
Yeah,
I'll
can
repeat the
you repeat
question.
the question, please? Thank you.
Yeah. So as AI moves from efficiency gains to value creation, will firms need to build specialist AI governance and security capabilities, or can existing teams realistically evolve fast enough if data maturity is already in place?
I think if you guys don't mind, I think I'll jump in and say you need to invest in governance 100%, like 100%. It's not the same game anymore We're not talking about machine learning. We're also talking about generative AI. Things can go out that you definitely don't want to get out. So the biggest, the most underrated investment is actually in the governance, quality, and management of your data. That's why I keep harping on this. So if you don't have this, please understand that you might get away with a quick win or two, but if you want to create something that scales, that you can transform, that you want to transform companies, then you need something that actually works repeatedly, accurately, doesn't create an issue that can literally tank your company. So you cannot, I think you cannot invest less in governance. You must do it. And like I said, you can have a data mature organization, but we are talking about a new set of tools that are available right now. So I would really evaluate if your company's your talent can include those as well as toolkits. So generative AI needs a very different kind of, and when you come to agents, it's going to be even more complicated. So I would say invest in it. It's unlikely that you might find all the talent already within your organization. If you do, then that's amazing.
Brilliant.
Yeah, I think what I would add also to this is that we are in an emerging paradigm of governance. We don't even know what this technology is going to look like in a couple of years. Therefore, we don't know what the risks are. We don't also know what we as a society, as governments, are going to um, deem as needing regulation. So one of the things that I would be very, very I would stress a lot is that there needs to be ongoing investment in governance and in governance foresight. So, looking ahead at scenarios, looking at the broader picture. Already with generative AI, you're starting to see questions around the environment and also cognitive offloading, sycophancy. All of these things are there floating around. We have to be cognizant of them, but at the same time, not be not be stopped by them. Yes, these things are potentially there, but you can build a governance and a risk model that recognizes them and responds as they develop. And that's really the key thing.
Brilliant. Thank you. I believe we have time for just one more question, and maybe from one panelist this time, before we're done for today. So, in your opinion, maybe I could go to Paul for this one. In your opinion, are PE firms underestimating the cultural or change management investment required to extract value from AI?
I would say yes, and it does all come down to people and being able to execute effectively and build that capability up. And that isn't something that can be shortcut. And as we've discussed before, going too fast too soon it can be a very expensive mistake to make. So it's we're talking about building things like capability roadmaps, understanding how I will mature the capability over the course of the whole period, and what the dimensions of that are. So, there's process and governance, there's technology and architecture, there's data, there are teams, there are partners. All of these things will need to come together into one cohesive strategy that sets out, how you intend to get there. The other thing is that if AI is going to be more than just a bolt on, it is going to be in every part of your organization as well. And what that means is a lot of training, a lot of familiarization. And coming back to governance again, everyone that uses AI in their day-to-day job needs to know the rules of the game at your company to stay compliant. And I think there's a lot of work to do there. So yes, that was a big question and a very broad one, but the short answer is yes, it can be underestimated. Yeah.
Brilliant. Thank you, Paul. Unfortunately, that's all we've got time for today. We've gone into a lot of detail on a lot of different topics. As a result of this, I just wanted to say we'll be sending out the recording for the webinar today, as well as the LinkedIn and info for our guests today, Paul, Manu, and Stephen. So big thank you to my panel for today's conversation, and I hope you've all got some valuable insights from it.
Thank you very much. It was great to be part of this. And thanks, Hugo,
Brilliant.
for putting it all together.
Thank you,
Hugo.
everyone.
Yep.
Thanks so much.
Good from me.
Thanks. Bye-bye
Thanks
now.
a lot.
See you
Bye.
later.